The IRS knew its locks were broken and filed nothing. Buried inside the court filing is a forensic accounting exhibit, never reported by major outlets, that maps 25,000 individual tax records to a single targeting database. The White House hasn't explained it. Neither has the IRS. The judge noticed. A sitting president just sued the IRS for $10 billion. Not a political statement. A federal lawsuit filed in court with a price tag. The named defendant isn't a rogue agent or a regional office. It's the IRS as an institution, and the judge didn't dismiss it. The public called it theater. Legal analysts called it a stunt. But federal judge Loren Ali Khan ordered the Trump legal team and the Department of Justice to jointly file briefs justifying why the case should move forward. Not a dismissal, not a fast-tracked motion to toss it. A sitting judge asking both sides to make the case for continuation. That's not how you treat an obvious loser. Here's what they didn't say. In 2022, the IRS's own internal audit, filed with the Treasury Inspector General, confirmed the agency's access logging system could not reliably track which employees had viewed which returns. They called it a data governance maturity gap. That phrase never appeared in any public press release. And that audit? It's now Exhibit A in a $10 billion negligence claim. The agency's own document, used against itself. It gets worse. That audit was completed before Charles Littlejohn pleaded guilty to walking out with thousands of files. They knew the logs were broken. They documented it, then said nothing. The underlying allegation traces to ProPublica's 2021 publication of the secret IRS files, a multi-year investigative series built on detailed tax return data belonging to the wealthiest Americans. Jeff Bezos, Elon Musk, Warren Buffett, Michael Bloomberg. Years of actual returns, effective tax rates, specific income figures, reported with precision that could only come from inside the system. ProPublica never named its source. Federal investigators opened a criminal leak probe. That probe has never publicly produced a named suspect or a conviction. The $10 billion lawsuit is, in part, the legal consequence of that silence. In 2022, Charles Littlejohn pleaded guilty to leaking tax data, not to a whistleblower outlet, not through a congressional channel, directly to journalists. He was sentenced to 5 years, the maximum under the statute, and notably more than prosecutors initially sought. The sentencing judge called it a crime against democracy. But Littlejohn's guilty plea covered the Bezos and Musk disclosures, not the full scope of the alleged leak operation. The forensic exhibit filed in the Trump lawsuit suggests the damage extended far beyond what Littlejohn admitted. 25,000 records, mapped, categorized, cross-referenced. That document has not been publicly released. The judge has seen it. One man pleaded guilty. He got 5 years. But the lawsuit claims 25,000 records were exposed. One person didn't pull 25,000 files. So either the scope of what Littlejohn did has never been fully disclosed, or someone else was involved. The IRS hasn't answered that publicly. The DOJ hasn't answered that publicly. And the criminal investigation that was supposed to answer it produced exactly one conviction. Set aside the dollar figure and the political noise for a moment. The people whose data allegedly leaked weren't only billionaires. The forensic exhibit in the filing, according to the court record, includes records flagged as belonging to mid-level executives, political donors, and individuals connected to federal investigations. Ordinary high earners, not public figures, people who filed their taxes and assumed the law protected them. The IRS privacy statute exists because tax returns contain what most legal scholars call the most intimate financial portrait a government holds on a citizen. Net worth, debt structure, medical deductions, divorce settlements, business losses. All of it was supposed to stay locked. Here is where the story shifts. The Department of Justice is currently both the defendant's representative, defending the IRS, and the executive branch arm that reports to the plaintiff's administration. The same DOJ. Trump is suing an agency his own administration controls. The lawyers defending the IRS work for him. That's not a conflict of interest. It's a structural impossibility dressed as a lawsuit. The judge's order requires both sides to explain how this proceeds without that tension collapsing the case. Neither side has filed that response yet. In January 2025, the Trump administration moved to install political appointees into senior IRS operational roles, positions historically held by career civil servants specifically to prevent executive interference in enforcement. That restructuring was announced while this lawsuit was in pre-filing preparation. Read that again slowly. The administration was reorganizing the agency. It was simultaneously preparing to sue for $10 billion. That is not coincidence. That is leverage. And it happened before any judge had seen a single filing. The lawsuit's damages figure, $10 billion, wasn't selected arbitrarily. Under the taxpayer privacy statute, plaintiffs can claim actual damages plus punitive damages. The filing calculates a per-record damage model, a specific dollar figure multiplied by each alleged unauthorized disclosure, then scaled by the punitive multiplier the statute allows. Run the math on 25,000 records with maximum statutory exposure, and you approach, or exceed, $10 billion. This isn't an inflated demand designed to be negotiated down. It's a number engineered to be defensible in court. Someone did that math deliberately. The conventional assumption: the IRS is a permanent institution. It survives administrations. It outlasts political pressure. Its independence is structural. What the court record suggests is different. 3 separate IRS commissioners have served since the ProPublica leaks began. The agency's own internal audit, filed with the Treasury Inspector General in 2022, identified systemic weaknesses in access logging for return data. Specifically, the system could not reliably track which employees had viewed which returns in a given window. The audit didn't call it a vulnerability. It called it a data governance maturity gap. That phrase did not appear in any public press release. A data governance maturity gap in an agency holding 150 million active taxpayer files means this: they couldn't tell you who looked at what. Littlejohn accessed thousands of returns over years. The audit confirmed the logging architecture couldn't have flagged his behavior in real time. It flagged it retroactively, after the data was already published, after the damage was already done. The IRS knew its own audit had identified this. The Treasury Department knew. Neither disclosed it proactively to Congress or the public until investigators compelled production. There's a second legal dimension the coverage has largely ignored. The lawsuit names not just the disclosure itself, but the failure to prevent foreseeable disclosure. That's a negligence theory layered on top of the statutory claim. It means the $10 billion isn't only about what leaked. It's about what the IRS knew about its own vulnerabilities and chose not to fix before the leak became possible. The 2022 internal audit, the one describing access logging failures, is, in that framing, Exhibit A for negligence, the agency's own document, used against itself. The DOJ's dilemma is specific and documented. If the department defends the IRS aggressively, it risks exposing internal communications about the Littlejohn investigation, communications that may reveal how much the agency knew about the scope of the breach before it became public. If the department allows the case to proceed without strong defense, a $10 billion judgment against the federal government becomes theoretically viable. There is no clean exit. Every legal move has downstream exposure. That's why the judge's order, requiring a joint brief from plaintiff and defendant, is the kind of procedural moment that determines whether this case becomes a landmark or disappears quietly into settlement. The IRS knew its access logs were broken. They documented it internally. Then Littlejohn walked out with 25,000 files, and no one was watching. The criminal case called it one rogue employee. The civil case calls it institutional failure. One of those framings ends with a guilty plea and 5 years. The other ends with the federal government writing a check. The story everyone told was simple. A bad actor leaked data, got caught, went to prison. Case closed. But a federal judge just looked at the same facts and said, not yet. 25,000 records, broken logs, a negligence theory, an administration reorganizing the agency it's suing. This was never just about one man. It was about a system that made it easy, and then called it an anomaly. The IRS processed 262 million returns last year. Every one of them assumed the lock held. The court record suggests it never fully did. This is Redacted Chapter. We dig up the corporate stories they buried. Subscribe. The next one's already in the cut.